When we're thinking about zero DT, I really want to emphasize the back test first because that is ultimately our guiding light. And when we're looking at that with the test trade track, we have to make sure that our assumptions are as accurate as possible. So when we put good information in, we get good information out. Hey, what's going on, you guys? Mark Anderson here, construction worker turned zero DT hedge fund manager. I was recently talking to someone I go back and forth with on Discord, and they were just comparing their actual trades to their results, and they're like, I've gotten great success with this. I've basically determined that it's just test, trade, track. And I'd already been doing this, but I like the words he kind of put to it. And I wanted to show also how I contextualize backtest as well as the sizing of them so I can meet my return. Because when we are doing this, even though trading may be a hobby, it ultimately is a business and we need to be tracking it and making sure, we're hitting our KPIs in that business. So when we're thinking about zero DT, I really want to emphasize the backtest first because that is ultimately our guiding light. And when we're looking at that with the test trade track, we have to make sure that our assumptions are as accurate as possible. So when we put good information in, we get good information out. When I talk about path dependence and sizing, the one example I wanted to give is kind of show you what this looks like in real time. So for example, with this trade, we both have $1 million account and they're using basically $10,000 of buying power per trade with the same 6 entries over the same exact time frame. However, one is sized at a 10% portfolio allocation, which would mean at day one it's a 10 lot, and the other one is sized at a fixed 10 lot over that period of time. So we can basically see here that there's a rather large deviation in returns. The one that basically sized up from that compounding has almost a 20% larger return over that time period, even though it's exactly the same. And the reason I think this is really important is because when we test, if slippage is slightly off, that can make a massive drag on our performance, as well as in years like this, the compounding will exemplify huge amounts of returns over what you would expect them to be. So I also did this exact same test in 2023, which was not as lucrative of a year with a 15.5% return, but rather only had about a 5% premium capture. And then you can see here that the results almost didn't deviate at all. So we need to understand that this cuts both ways. So if we get real slippage in real life, that is $5 more, or we're now trading a trade that is extremely leveraged in a backtest that we're expecting to get something, we can go from having a positive return to a negative return based on what our assumptions are in the backtest. So the thing I want to impress is if we're selling volatility risk premium, we have implied volatility minus realized volatility minus commission, slippage, and fees. So the commission, slippage, and fees is almost as important as the fact of what we're selling to try to capture that volatility risk premium. So I see a lot of people that will trade spreads, like they're managing the order on the spread, and that's going to incur more slippage. So that needs to be made up for. And a lot of people love these kind of like break even 1x iron condor trades. But the other thing I want to show here is in a really good year, our expected return per trade is $22. And then in a not so good year, our expected return per trade is basically 8 cents. So right now this has 10 cents of entry slippage and 15 cents of exit slippage. And what I want to impress basically on that is that if our expected return is $22 and $8, 5 cents additional slippage represents 22% and 62% of our profits respectively. This is why when we set up our test, we much beat the back test with our assumptions. And this is relatively easy with the automation. We can check what our slippage is every day, but you can see how that can have a massive effect. So on a really good year, we outperformed the trade by 20% just because the compounding was more versus a fixed lot. So this is why I always like to test with the fixed lot. And then on a bad year, it basically had no variance. But you can also see on a bad year when our expected average return is only that $8, if we get an extra sense of exit slippage, we lose 62% of our profit. So you can see, even though this may look attractive, if our expected return is $8 per trade, and 5 cents of slippage can basically nuke our entire trade ability to make money, it makes a lot of sense to get less leverage and buy a 5 cent wing, even though that may be $200 wide, than to be $75 wide and then eat an additional 5 cents of slippage. So I just want to show that importance in regards to that. To further make this more accurate, kind of getting rid of just looking at the back test with accurate slippage assumptions, I also want to show how I size stuff, and this is to kind of eliminate the path depending of the of the compounding out of the equation, similar to how this one outperformed by 20% just from the compounding. So basically what I do is I take those back tests and I put them in a Monte Carlo analysis. And basically what a Monte Carlo analysis does is it takes your average profit per cycle, which was 36 basis points, that's basically a daily return, and then you have your standard deviation of 0.9%. So I run this 1,000 times with that data, and it just randomly basically shows what the path dependence could be over those 1,000 cycles. So we're kind of taking the data from 8 years and then we're running it over 250 years, because we obviously can't do that with actual back testing. Things change. And at the end of the day, what happened is with our 95% confidence interval, which means a 2.5% on probability on each side. And this is important because we have 70 trading days in a year. Who knows, maybe we're doing 10 trades a day. We're gonna get to that 2 standard deviation confidence interval. Even though that sounds a lot, it's like it happens every quarter, it happens almost every month. So now that we have this, I know that my return here with a 95% certainty is going to be 9.6% and a max drawdown of 5.3%. What this did is over a quarter, it gave me a 3.2% standard deviation. And basically what that looks like, if my average return is 9.6%, that means with a 68% certainty, I know my quarterly return will be between 6.4% and 12.8%. Then with a 95% certainty, I know my return will be between 3.2% and 16%. And this is just further going down along the lines of why it's important to have the right backtest inputs, because not only are we compounding those in the backtest, now we're compounding them in a simulation, and I match mine within 2.5% to 5% of the actual performance in the backtest over thousands of trades. And that's basically my line in the sand, because that's going to give us good data in and good data out. This also shows that our max drawdown is minus 5.3% with a 95% confidence interval. So if we add that 3.2% standard deviation, we know that within a 3 confidence interval, which is roughly 1 in every 300 times, so once a year, we could have up to an 8.5% drawdown, and then once in 30 years or a 4 standard deviation confidence interval, we could have up to an 11.7% drawdown, which we start to get in the territory of vol drag, which is if we have a 10% drawdown, we need an 11% return to get back to even. If we have a 20% drawdown, we need a 25% return to get back to even. So now that I have this guiding light of I'm going to go after this 10% return and I have my confidence intervals, how I like to do it to eliminate the compounding is very conservative with my back test. Let's say I do about 10% of premium I sell in premium capture. So if I wanted to now make 10% over the course of the quarter, or 3.3% a month, that means that I have to sell about 10x that over the course of a month, which is about 22 trading days. So if I'm selling 1/3 of my portfolio in credit and I expect to capture about 10% of that in premium, that means that I will get or have to sell about 1.5% of my portfolio per day to capture that. The other thing in regards to this is, sure, this looks all good, but going back to the good data in and good data out, if we are using filters on our trade, not saying it's good or bad, but all that a filter does is it potentially introduces more path dependence. So if I have a trade that trades 5 days a week at the same time, no matter what, that's going to give me a much more accurate prediction of how my backtest is going to perform over a period of time. Whereas if I use one filter and I filter out 15% of trades, by doing that, I could potentially open myself up to deviating from that backtest much more. It could be much better and it could be much worse, but my certainty and my ability to perform against that is just going to be more difficult. And this can basically be displayed within this confidence interval is if we're giving data that has more filters on it, this is just going to be less and less accurate as a statistical fact. And the other example I like to give of that is, so my portfolio is, let's say, 10 times SPX notionally. So that means if I'm trying to sell 1% of my credit in one trade and 0.5% of my account in another trade, it's easy for me to do that because I can size exactly at a 14 lot and exactly at a 19 lot. Whereas if you're a 200 grand account and you're now trying to size at 1% and 0.5%, now you're rounding up from a 1 lot to a 2 lot, and instead of selling 1%, you could sell 1.3%. So you're playing the game you're in, not saying that's a bad thing, but the less data sets you have and the closer you are to selling exactly that 1% instead of rounding up to 1.4%, just the more likely you're going to deviate. So if you have a small account, you can't do much about rounding up between a 1 and 2 lot, but you can do everything with a back test. So I really just like to impress people. It's like better data, outperform your back test, get this in so we know exactly what to do. And then we're going to take our forward testing and we're going to compare that to our back testing. And when we're looking at that, we know that the entry premium is going to vary from day to day, because when it gets into the trade, the back test just takes it right at 932 with 5 cent slippage or whatever it is. Whereas when we're shopping in the actual market, the dynamics change. I just kind of wanted to give you guys a rundown of this. If this is helpful, please comment or let me know what else you guys want to see. If it wasn't understanding, feel free to message me. I just want to make sure this is as clear as possible for everyone and you guys get it. Thank you.